Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Dan Rasmussen, founder of Verdad Advisers and author of The Humble Investor.
We've had Dan on the show before. He's a very smart guy. I read his stuff just about every week. I want you to get a load of what he's got to say because some of the material in his book is absolutely essential, must-read investor material. So let's talk with Dan Rasmussen. Let's do it right now. Dan, welcome back to the show. Good to see you again.
Thanks for having me on.
Yeah, we kind of had to. I got this book delivered to me recently that had your name on it, so I thought, well, we should get him in here and talk about that. I get a lot of good. Yeah, you bet. I get a lot of good emails from you, and so I thought, well, if he puts the stuff in a book form, it's probably pretty good. The book, just so everybody knows, is called The Humble Investor: How to Find a Winning Edge in a Surprising World. And it's got like little notes on the jacket by people like Patrick O'Shaughnessy and Michael Mobison, who we've had on the show as well. So why do a book? Why do the Humble Investor at all?
Yeah, I've been writing my weekly research emails since 2015, and so it's been about 10 years, and I wanted to put them together in a book of my sort of best ideas and also try to summarize sort of the theme and the logic that governs all of what I've been writing. You write a lot of short weekly pieces, but I wanted to step back and say, hey, here's the argument or the perspective that's underlying all of this content.
Mm-hmm. If we were just sitting around a bar and I was saying, well, okay, what is that? What is the arc? What kind of investor are you? Is what I would ask.
Yeah, my favorite motto in investing is that investing is not a game of analysis; it's a game of meta-analysis. And if there's one thing that defines my approach, it's that. And I can walk through a few different illustrations of that or what that means in practice. I'll start with one of my favorites, which is Ken Arrow, who was the youngest economist to win the Nobel Prize. Was assigned to the Weather Service in World War II, and he was responsible for producing long-range weather forecasts. And after doing this for a few months, he looked at the results and he said, "Well, gee, this is worse than just using an almanac. This is a complete waste of time. No one knows if it's raining 4 months from now. Why are we doing this?" So he wrote up a memo to his commanding officer and said, hey, these forecasts aren't worth anything. You should fire the entire Weather Service and just use an almanac. And he got a telegraph back from his commanding officer, and it said, well, the commanding officer knows that the forecasts are worthless, but he needs them for planning purposes. And I love that story because I think so much of investing is focused on planning purposes, right? And we miss the fact that the forecasts are worthless.
Right. That's the joke. This is the joke about the guy who's looking for the drunk guy who's looking for his keys under the street light. And he said, and somebody comes on and says, "Where did you drop them?" "Well, I dropped them over there." He says, "Why are you looking over here?" "Well, this is where the light is." Exact same story, right? Anyway, go ahead. That's a great story.
If there's one, a sort of first instinct that sort of informs my work, it's a skepticism of forecasts. Right. Let's be skeptical of our own analysis. And, investing is a game of betting on forecasts. So I think we have to start with this sort of a radical humility or even nihilism about our ability to predict the future. And that's why I love that Ken Arrow story, because it shows that, sometimes the smarter you get, the more you realize you don't know anything. If Ken Arrow thinks the forecasts are worthless, probably our forecasts are worthless or close to it as well. Now, the second story is one that I think shed lights on the efficient market hypothesis, which is there's one of my colleagues, Sam Hansen, wrote this beautiful paper about Greek shipping, and it's fascinating. And what he finds is that when shipping prices are really high, what tends to happen is that the shipping companies go and order new ships. So they run a discounted cash flow model and they say, hey, at current shipping rates, I could make a fortune building new ships. If I had twice as many ships, I'd be making so much more money. And so all the math pens out, and I'm going to go call up the South Korean and Chinese shipyards, and I'm going to order a bunch of ships to add to my fleet. Problem is, it takes 2 to 3 years for the ships to get built. And so 2 or 3 years go by, and then the ships are delivered, and all of a sudden they find that shipping prices have cratered. And they look around and they say, well, why have shipping prices cratered? And they say, well, there's a glut of new ships on the market. And then they realize, oh, it wasn't just me that ordered the new ships when shipping prices were high. All my competitors also ordered ships at the exact same time because they saw the same thing that I was seeing. Sam Hansen calls this competition neglect, right? We forget that we're competing. We forget that other people are looking at the same data that we're looking at and making the same type of decisions. And so you can't just be wary of your forecasts. You've also got to be looking and thinking about the data you're using to make decisions, and thinking, what are my competitors doing with this data, right? Are they coming to the same conclusions? Are therefore our markets being driven in this sort of recursive way by everybody looking at the same set of data, coming to the same conclusions, taking the same set of decisions? And is that really what's contributing to a lot of market volatility? It's this swing of this correlated beliefs and the way those correlated beliefs can drive cyclicality in markets. So those are sort of the twin underpinnings of my philosophy, right? Radical skepticism about forecasts, and then a hyper awareness of thinking not what's the right analytic thing, but what's everyone else coming? What conclusion is everyone else coming to? And therefore, what should I do if the forecasts turn out to be wrong? And therefore, everyone else's correlated beliefs, and the more correlated the belief, the more everybody agrees on something, the more likely it is inevitably to go bust.
I thought you did a great job of using, your ideas about forecasting and the specific example of the shipping paper that you just mentioned um, in discussing AI recently. And I thought, yeah, for
Yes, me
me,
too. I read that note as well.
yeah,
Yeah.
for me, it's like mining. That's the thing I'm familiar with, because it's the exact same dynamic as shipping. He could have used mining, and it would have been the same thing. Well, we've got all this money. We just made a bunch of money, and we think we have more prospects that we can build more mines, and they get the thing built. In that case, 5, 10 years later, whatever it is, and the industries, the prices are in the toilet, and it's the same thing. Um, but to talk about that in reference to a technology, I thought was a little smarter, because most people don't think of it that way. They just get so optimistic about the forecasts and the new technology, and they don't see the tens and tens and hundreds of billions. Goldman Sachs estimates, I think by 2030 or some time in the near future, $1 trillion total investment going into AI. It's the same thing, and nobody's really made a dime yet.
Yeah, and
Just like with
it's
the
us.
ships and the mines, right?
It's like
Nobody's,
those of us who are familiar with these old economy things where there's a return on investment and there's capital spending, right? The
yeah,
software guys have been out of that game for a while, right? They've been in the game of, you write a line of code and the marginal cost of selling that code is infinite, and there's no capex because all it is playing software engineers, and that's all in the income statement. And so for
mhm,
years, and in some sense, that's why software is one of the best businesses in the world, if not the best business in the world. It's infinitely scalable, zero marginal cost, with no capital intensity.
yeah,
And I think what's sort of fascinating is that
yep,
all these stocks have gone massively up on the news about AI. But I look at it and say, well, AI is a capex game, right? They've gone from the best business in the world to a highly capital intensive, they're turning knowledge work into a manufacturing problem, right? Where you need
right,
to, have all these GPUs and servers and a data center that's powered by electricity, right? You've gone from the best business in the world to the worst business in the world, and investors have somehow rewarded you for it, right? That the capital intensity of like Meta and Google and Amazon is now like double that of the industrial sector in the
right.
United States. How crazy is that, right? Not only, right, is this massive increase in capital intensity, but around the competition point, right? They're all betting on the same thing, right? They're building the same type of model. They're building the
Yep.
same data centers, right? They're total like how can all of them win, right? That's not the story of the past, right? The past has been MySpace goes out of business, Yahoo goes out of business. There's one winner in search, one winner in social, and I wonder if we're not making multiple mistakes here with AI.
And you'd think at some point somebody would say, the poster child for this optimism is a semiconductor stock of all things. NVIDIA,
Right.
right? It's a semiconductor stock. Has that industry been a little cyclical here and there over the years? I mean, when that industry gets killed, it gets killed. Have you heard of the dot-com bust? The semiconductors were getting crushed before the rest of it. It's yeah, yep, good analogy.
Well, and this is where the human nature comes into it too, right? Nobody wants to be the one to be left behind or perceived as not, knowing what they're doing, right? I guess you heard some of that with like Apple during this run, last 2 years, and even they were forced to seemed like they were forced to just, hey, we're going to put AI on our phones now, like, and here we go. So
Yeah, and I think you have this sort of interesting dynamic, right, where um, the beliefs become correlated when they become, they sort of happen and they become true multiple times, right? So if you sort of say, hey, my belief system is that international stocks are better than U.S. stocks, for example, and you go out with that in 2018 and U.S. stocks outperform, then you go out again in 2019 with your belief system and U.S. stocks outperform, right? By the end of that, you've been totally discredited, right? Nobody believes that your worldview is the right worldview. Conversely, if someone said, you know what, you shouldn't just own U.S. stocks. You shouldn't just own U.S. growth stocks. You should only own the biggest U.S. technology stocks. And that was your belief system, right? It's been right over and over and over again. And the more that you're right, the more credible you become, and the more people's beliefs move into alignment with yours, right? And so the international investor, no one's listening to him by the end of the 5 years. And at the other hand, everybody's listening to every word that comes out of the guy's mouth that thought that you should put all your money in the 5 largest growth stocks. And that's where this sort of recursion of belief starts to happen in markets, because the minute everybody starts agreeing, that creates this huge problem, right? Where people's beliefs are too correlated, it creates exactly the types of cyclical shifts in valuations. And then when the future is surprising, which it inevitably is, the rug just gets ripped out of and then all of those people who had these sort of shallow belief systems get destroyed, and then some new fad happens. And what we've seen in the US market again is this, the sort of a surpassing amazingness of technology shares for years and years and years. And people have just gotten so pushed into owning that or overweighting that type of stuff, if that's where they thought they were going to get returns. And if the market changes, as it inevitably will, and the cycle turns, gee, that's going to be problematic.
And it could very well be turning as we speak. If you had told me when Trump got elected that, okay, now Europe's going to outperform the US starting right now, I would have said, that doesn't make any sense. He's going to put tariffs up and all this business. But that's exactly what's happened. So this cycles turn at funny times, don't they? Potentially here. I'm not saying it necessarily has, but this feels like that kind of moment, doesn't it? In early 2025, it feels like um, the market has gone up and up and up. Those biases, that narrative, it's been reinforced again and again and again and again and again. And it's probably time for my Corey just told me before we got going here that the Mag 7 is kind of officially in a bear market, down 20%. It feels very like a big moment here, like a big cycle change moment.
Yeah, and I think there's also, there's a number of things going on. I think there's been a lot of neglected risk, right? You look at any of those individual Mag 7 names, they're very high volatility stocks, right? They are, right? You look at the standard deviation, they're risky stocks. Now they've only been risky on the upside, and so people don't think about it. But gee, these are not like low beta stocks. They're very high beta stocks that just happen to do very well. On the other hand, if you go to say Europe or Japan, you find a lot of stocks, very low volatility stocks with 5% dividend yields or something, right? That I could show you dozens of those, if not hundreds of them in international markets. Some international markets are now, lower beta and much cheaper than the U.S. market. And so
Right.
it's there's a sort of a variety of dynamics that have occurred in this market, one of which is that I think people have looked at cheaper valuations abroad and they've gone there. Another is there's been de-risking. People have actually gone to what they perceive to be safer, which are higher dividend paying, lower beta stocks, which happen to be disproportionately these days in international markets. And another thing that I didn't realize, and I was trying to piece it together, Dan, because I had the sort of the same question. How Trump's America first, shouldn't that have favored U.S. equity markets? It certainly did in his first term. Tariffs, shouldn't that favor U.S. equity markets? But I think what it turns out is that there's more foreign capital in the U.S. than there is U.S. capital in foreign markets these days. And so once you start to erect trade barriers and once you start to create that sort of salience, actually the U.S. capital markets have more to lose than international capital markets. It's not like U.S. investors are massively overweight the Nikkei 225. But if you look at the top holdings, for example, in Japanese NISA savings accounts, it's like Palantir and Microsoft, right? Like the Japanese guys aren't like, oh, I'm going to put all my money in like wagering that Japan Post is going to have a great month, right? They want to bet on Palantir just like you do. And so there's this global capital flows into the U.S. that now seem to be reversing. And I think the other point is on this meta-analysis thing, right? The valuation gap between the U.S. And international just reached such crazy levels. The optimism around the U.S., right? And if there's just one simple rule, it's like when there's too much optimism, you've got to take the other side of the bet.
You're also reminding me of another area. I just happened to listen to a presentation by a friend of ours, Rick Rule, and he's talking about how under-invested folks are in gold. And very similar, right? When you are paying more attention to big cap mega tech than anything else, when everybody in the world thinks that's the absolute best trade there is, a lot of other stuff gets neglected. And you talk in your book about how to build a counter-cyclical portfolio. I think you have a chapter on that, don't you?
Yeah, and I think gold is so interesting. It's a funny asset class, right? It's very hard to predict gold. What moves gold? Is it central banks? Is it people loading up on gold at Costco? Is it real interest rates? I don't know, and I've done a lot of research on it. It's really hard to know. But what I do know is that gold has very valuable portfolio characteristics. So I think of every investor needs a low risk asset. You need low risk to balance out your high risk investments. You need diversification, right? You can't put all of your money in the best returning things. Okay, maybe in your 20s in your retirement account, yes, you can be 100% equities, but everyone else needs some safe assets, some buffer assets. And I think there are really two, right? There's treasuries and there's gold. And I think that gold was for many years kind of neglected. People sort of lost interest in gold as a safe haven asset because treasuries were doing so well. Interest rates had gone down for 30 years in a row. People had forgotten there could ever be inflation. And I think one of the key things is that when there's inflation, treasuries go down and gold goes up, or certainly in dollar basis. And so you should think of diversifying your safe assets. You shouldn't just own treasuries. You should own gold as well, but no, not enough people do. And so I think what's happened is that gold had been really underallocated. It's probably still really underallocated. We own in one of our multi-asset portfolios, we have 25% of the book in gold, right? Which is probably an extreme level, but gold's a very useful tool in portfolio construction. And I think people have neglected it, right? A lot of people have been focused on crypto, which is not a safe haven asset. And gold is, gold has stealthily done just remarkably well over the last 2 years.
Stealthily, yeah, it's right there in front of everybody, but nobody pays attention to it. And people say, I mentioned our friend Rick Rule, and one of people's favorite questions for him, since he's kind of a natural resource guy, is when's gold going to move? And he said, well, it's gone up 8% per annum for 25 years. You know what I'm saying? It's done its job, as you point out. It's been a great portfolio holding and done its job.
And there's a wonderful story. There's another paper I really like by Campbell Harvey, and he found that the price in gold that you pay a U.S. Army captain today is the exact same price in gold you paid a Roman centurion, right? So gold has preserved its purchasing power over thousands of years, right? If that's, think about, even treasuries or something, right? U.S. treasuries look like Bitcoin relative to that in terms of how long they've been around, right? Gold has been a store of value for so long that I feel like you can know that it's in the, you can trust that 1,000 years from now, will U.S. Treasuries exist? Who knows? But gold will exist, and it'll probably be roughly as valuable.
Yeah, I like Cam Harvey. We've had him on the
Yes.
show. I'm writing that down.
Yeah,
I
that
got
was
to
great.
find that paper.
Yeah, to which I say, let people keep forgetting about gold or not paying attention to it.
Yes.
It's great. If you own it, you're happy, right? Like,
Yep. Yeah, very happy gold owner.
yeah.
There was another section of the book, and I hope you don't mind. I'm just going to, hit on a few ideas in the book because I think it's really great. And I've been reading your stuff, the weekly stuff, for a while now too. But there was a great question in there about predicting bubbles and about how you know when we're in a red zone, which and you mentioned Hyman Minsky too, which who I think is a really interesting figure when discussing bubbles. Maybe talk about that a little bit. Can the question stands? Can you predict bubbles? I mean,
yeah. So first, I think one of the ways I looked at this question is I went and read through most of the great investors, or at least the ones I could think of, and could find their letters from the '90s on, because I wanted to know, right? Like in retrospect, we know in retrospect that the '90s were a bubble, but did it appear to be a bubble at the time? Was sort of my question. And it looked like almost every single one of my favorite investors knew that we were in a bubble. The only problem is they knew it in 95, 96, and 97. So by the time the bubble actually burst, they'd been making bubble calls for 2, 3, even 4 years and been wrong, right? Like, I think it's a bubble. Then the market goes up 50%. I still think it's a bubble, and the market goes up another 50%. So they'd been so thoroughly discredited in some sense by 99, 2000 when it actually turned. And yet, if you looked at their returns through 2001 or 2002, the bubble went up and then it went down so dramatically that they ended up ahead of the market. Even if 1999 or 2000, they looked like the world's biggest idiots, right? And the most, conservative, boring, Pollyannas. And so I think that there's huge psychological challenges in a bubble, right? And the biggest psychological challenge is that the bubble is inflating at the time. And the smarter you are, the earlier you realize it's a bubble. And the longer you have to deal with this cognitive dissonance of watching something you think is overvalued or crazy get even more crazy. And so I think that we should move back to saying, hey, we don't know with precision when a bubble will burst, or even if we're in a bubble, but we can assess that there are conditions that make bubbles more likely. And the biggest thing that is a hint of a bubble, or increases the probability that a crash is going to come, is the easy availability of borrowing and the massive expansion of borrowing. My favorite metric for looking at credit markets is the high yield spread. And the longer the high yield spread is very low, which means that borrowing is freely flowing into corporate America, the higher the risk of a crash. And we've had credit spreads that have been so low, right? They're below 300 basis points, which is just like crazily low. And they've been that way for like a year now, maybe even longer. And what that means is that people have been able to massively lever up. And you don't always know where the borrowing's happening. I can point to a few places. But that availability of credit is one of the preconditions to a bubble, and one of the preconditions to a crash, because crashes, as Minsky points out, they come at these moments where leverage just gets called, and people realize, oh my gosh, I can never repay this debt. I've borrowed too much. And you have this kind of crisis of beliefs, and everything kind of goes out all at once.
Credit. Yep. It's always credit, isn't it? That's what always, the crisis is always about credit. It seems.
It's always about credit, and it's always, it sort of has this pattern to it, right? Where you say, oh, why would I hold treasuries, or why would I hold cash? That, the yields are too low. I want to reach for a little extra yield. And you lend to something, and then that thing doesn't go bankrupt. And so you say, wow, I earned a little bit more return, and there wasn't any added risk because it didn't go bankrupt. I should lend more. And so you lend a little bit more, and then people start to supply you with things to borrow to lend to, because they see that there's demand. And I'd say, the sort of obvious example in today's market is private credit and private equity, which has just been this massive expansion of low quality credit, to the point where private credit dwarfs the high yield market in terms of size. And all of this borrowing is at, pretty high interest rates. And it's generally to very small, very levered companies. And I think if there's a place that's the most likely center of problems, it's private equity and private credit, where you've just seen this massive increase in leverage. And I think there's this dynamic of the wealth effect, which people have written about, and it's a cool idea, right? Which is that, if you think of credit is secured, equities in front of the credit, and so, on the one hand, if you said, hey, I want to lend someone 8 times EBITDA of debt, without knowing anything else, you'd say, well, that sounds like a lot, right? That sounds really risky. But then if you said, well, a private equity firm is paying 16 times for the business, so we're only putting 50%. So they'd have to lose all their money for us even to get impaired. And that's $1 billion of equity in front of our debt. All of a sudden you say, well, those private equity guys are pretty smart and they're putting in that much equity. I should feel pretty safe with my lending. And so what you can see in the U.S. equity market is because valuations have gone up so much, it's creating this wealth effect. And that wealth effect has been allowing for the expansion of credit, especially in the private equity world. And the challenge is when that reverses, if there's an unwind, it can be painful because it's built on a fantasy, which is these very, very high valuations, which don't necessarily need to persist.
Yeah, and it seems
Yeah, I
like
really enjoyed the chapters on private equity in the book that I've been listening to, because it's a little self-serving, because to me, like the last year or two, especially, you're hearing private equity, private credit, you just hear it constantly. Like it's where everybody wants to be. And to me, I'm like, okay, well, you can't really tell what's going on, first of all, or a normal person can't. And so what, I mean, to you, what if things unwind there, what does that look like, and how what are the scenarios you kind of see possibly playing out in private credit if things go south?
Yeah,
or private equity as well.
So, yeah, I mean they're the same thing, right? They're just, one is the debt and one's the equity, but it's the same business. And the business is fundamentally taking very small companies, very small private companies, and changing their capital structure to a mix of debt and equity that's funded by pension funds and endowments through these private equity funds, and that's the business. And these days, there's this whole market where 40 or 50% of the transactions are sponsor to sponsor. So one private equity firm sells it to another private equity firm, and it just creates this sort of cyclical thing where the more money in the asset class, the higher the valuations, and the higher the trailing returns. And so everyone sort of benefits as long as this sort of closed system keeps taking in new money. And I think the challenge is that what happens when the money starts drying up, and that's what's been happening. So we've had the first decline in private equity assets under management ever. Private equity AUM is down about 2%. And the driver for that is that there haven't been many exits. The hold period on these private equity deals is getting longer and longer. And when you say, well, why aren't there any exits? The reason is that they paid too much for them, and so they can't get a good rate of return if they sell them at current prices, so they're holding them. And the same thing is happening with private credit, where there's more what's called PIK interest, or payment in kind, where someone says, well, instead of paying you interest, I'll just increase the amount of the size of the debt that I owe you. I'll just pay it at some point in the future. And so you're seeing increased hold periods, delays in selling, and you're seeing increased PIK interest. And I just think, well, both of those are really bad signs. Right. But, and the more that you see, you can extend and pretend, you can hold an asset at the same mark and hope no one notices. But at some point, your investors are going to want their money back, and they don't want cash, not more debt, or not an extension fund. They want cash. And I think that that's the problem that private equity is facing right now. And I'll note that I've been critical of private equity probably since 2018, and the 2018 through 2021 or two period was fine. Nothing bad happened. In fact, it was sort of roughly equal to equity returns. And so you can accuse me of being either early or wrong on private equity, but I look at the data right now and I say, I think we're here. I think the reckoning is here. And it's just a matter of how painful it gets.
Yeah, AUM being down first time sounds like a big hint. It's interesting to me that these private credit and private equity, you don't get. You mentioned, they don't mark. One of the problems, they don't mark their, the asset down and hope nobody notices. That to me, Cliff Asness has a point about this that he likes to make. It's like it's I forget the term he used, but it's basically,
Volatility laundering.
Volatility laundering. Thank you. So, so you just sit there and you leave the mark and you say, well, it's worth $1 billion. It was worth $1 billion last year. It's worth $1 billion this year. Every other similar asset is down 30% in the public markets. But hey, ours is better, even though it's like probably 10 times more levered. That is
and I think
such a
you
weird state of affairs.
And you see it, interesting that the private equity stocks are down massively since Trump's election, right? So, their funds are marked at 1, but the share price of KKR, they're plummeting. And you sort of think about that and what that might mean. But I think this, one of the real sort of problems with this is that someone calls it the phony happiness of private equity. And I think one of the challenges is that understanding risk is really important to making good investment decisions, right? Like, yes, okay, we all want to invest in the highest return thing, but we also need to manage our risk. Risk management matters, right? You don't just put all of your money in the thing you think has the best return, because no one's that perfect and things inevitably blow up. And so you want to be diversified, you want to manage risk. And one of the challenges to private equity and private credit is because the marks don't move, right? So corporate private equity has about the same volatility as investment grade bonds if you look at the marks, right? And I think the problem is investors' experience of private equity. Private equity doesn't feel particularly risky to them. Why? Because it feels sort of like corporate bonds. It feels less risky than the public equity market, right? Public equity market's down 10%. Private equity's not going to be down at all, right? And I think that as a result of that, it's enhanced the amount of risk people are willing to take in private equity. They're willing to put larger shares of their money in it, and they're willing to allow the underlying managers to put on more debt, because it just doesn't occur to them that there could ever be a bad outcome, or that it could ever be all that problematic. Or, right? Nobody's really like thinking about that private equity fund that blew up, right? Whereas they all are aware of some asset class or hedge fund strategy that blew up. And I think the fact that they don't think that levered microcaps are risky is a danger sign, right? It's just a clear correlated belief that's clearly wrong, right? Levered microcaps are more risky than liquid public markets, period. End of story. And if you are putting 40% of your portfolio in them thinking it's less risky than publics, you're nuts.
The definition of nuts for an investor right there. So what, we know you own some gold in your portfolios. What does the rest of that allocation look like for, do you have like a flagship portfolio, or do you just have many different strategies? How do you do things at your shop?
Yeah, we have a bunch of different strategies. I was speaking from real world experience and being long international. We're big investors in Japan and especially and Europe, in small cap value in both of those regions. We have some strategies that focus on those. Japan's a really cool place to invest. We love investing there. It's very uncorrelated, and a lot of what's going on there is these corporate governance reforms, where you're trying to the Tokyo Stock Exchange is trying to get all Japanese companies to trade at greater than 1 times book value, and a huge swath, call it over 1,000 Japanese companies, trade at below 1 times book. And so there's all this sort of corporate reform going on. And what you sort of your first reaction might be, well, if you told a company that's trading at 10 times PE to trade at 20 times PE, well, there's not much the company can do, right? What are they going to put out, new IR presentation or something, right? Right. It's kind of silly. And so, the first reaction to this price to book guidance is, well, gee, that sounds kind of silly. How are you going to get companies to just change their valuation? But in Japan, it's actually strikingly easy, because the median Japanese company has 50% of their market cap in cash and 50% of their market cap in cross shareholdings in other Japanese companies, which people don't realize. So you can immediately get to 1 times book by just selling your cross shareholdings or using your cash to increase dividends or buy back shares. And so you're just seeing, as the companies sort of figure this out, and they sort of have this moment of enlightenment where they say, oh, this is not a hard problem, it's an easy problem. I just increase dividends and pay the dividends out of my cash pile or out of my public share cross shareholdings. I'm going to see stock price appreciation. And we're sort of remarkably in the early innings of that, where Japanese management has, the first phase was saying, oh, I'm going to grow my company more and improve return on equity, and it's sort of these, empty promises. And then the next stage was, I'm going to sell 5% of my cross shareholdings and that'll satisfy you. And now sort of the third wave is people saying, I'm going to triple dividends, and the way I'm going to do it is through the balance sheet, right? And that's what's finally working. And so Japan is a really interesting place to invest because there's such an obvious catalyst, and it's so clearly a path to getting to doubling your money on some of these micro caps that trade at half a book. So that's a big portion of what we do. We also do a bunch of high yield credit, and then we have a multi-asset portfolio where we're dynamically optimizing a market neutral portfolio based on return projection, volatility projection, and correlations, and trying to say, gee, what's the right portfolio given the current macroeconomic conditions? And it's in that portfolio where we own a lot of gold at the moment, which is symptomatic of being relatively concerned about the market, at least in the short term.
How much of that portfolio is treasuries?
Zero.
Oh, zero.
We have no
25%
treasuries
gold,
right now.
no treasuries.
We own some corporate credit, about 30% in corporate credit, but no treasuries right now. We've been short treasuries, and then we took that trade off this year, which was good timing to take the trade off because treasuries have done well this year. But we haven't gotten comfortable being long treasuries either because there are still some inflationary risks in the economy that people are probably underpricing.
I see. And how about, well, there's treasuries, and then there's like T-bills. Do you care about?
Very limited exposure right now, and then I'd say within our equity book, we're short a lot of highly volatile small cap U.S. growth stocks, and we are long a lot of high dividend paying international value stocks, and that's been a wonderful trade so far this year. And I think right now we own almost no Mag 7 exposure, maybe 1% Mag 7 exposure. We're just neutral to not interested in those names at the moment.
Right, because the whole world is still pretty interested, even though they're not performing so great. I mean, they didn't do great.
Yeah, I don't think there are that many people that own more in gold than in the Mag 7, so count me among
That's right. Exactly. Nobody owns more gold
Well,
than
that's
Mag
why
7.
you're doing so well right now. Yeah. Sounds like you just ticked off about 4 or 5 things that I think are all working probably as best as you can imagine.
Yeah,
right?
Corey, I'd either say a broken clock is right twice a day, or all the things I've been saying for years and was wrong about last year and the year before, I'm finally right about. So who knows? You can look at it differently, but hopefully we'll continue to be right because it's been a very good year for us so far.
I was heard the comment you made earlier about all your favorite smart investors being early to call the bubble, and I thought, oh well, from now on I'm going to go around saying Dan Rasmussen says I'm really, really smart. So because I'm wrong on these things again and again, and then all of a sudden I'm right and say, hey, we have an annual conference that we do, and they say, hey Dan, you were right this year. Literally, that's what they say.
Well, I think better to be right in the end, right? Better to be right now and wrong early, right? It seems like perhaps that's Trump's approach, right? Take the bath early and then hope that the things rally later on.
Right, and it's not like when we're saying we're wrong about calling the. It's not like we abandon. In my case, we don't abandon equities. We don't stop making long, recommendations and allocations and things. That's not it. It's just the level of concern, you wind up allocating differently, and you underperform the bubble. Right. That's the problem. You underperform the bubble and erode your credibility.
Yeah, and it's so funny because I wrote a lot last year about diversification and the benefits of diversification, and people kept saying it's diversification. It's not diversification. It's diversification, right? Like diversification doesn't work anymore, right? I got that response so many times, right? And you're like even like forget even like making alpha calls, right? Or saying like, hey, here's my market view, right? There's just like, hey, be sensible, right? Like don't put all your eggs in one basket, right? Don't anticipate that the thing that's been working best last year is going to be the thing that works this year, right? Like the sort of like old wisdom. Like I know a lot of like older investors who I love talking to are in their 60s or 70s, and you talk to them and they say, well, I've been through this cycle, I've seen that before, or this feels a lot like that time when things got overheated, and just stay the course, and don't get wrapped up in the fad, and it's that sort of like basic old school logic. You're trying to say, hey, gee, maybe you should own some international equities, and maybe you should own some gold, maybe you should own, right, like, maybe you should have some bonds as well, right? They don't look all that bad right now. But you couldn't talk anyone out of the S&P 500 at all. Like it's been just, you're talking to a wall. People only wanted to own the S&P 500, and I think you're seeing people pay the price for that this year. The sort of pain on Twitter or on TV suggests to me people that just weren't properly diversified, because properly diversified investors are doing fine this year.
Yeah, and that the dynamic too in the S&P 500, as another previous guest of ours, Mike Green, has been talking about for a few years now, um, is, he contends made worse even by so-called passive investing, which is not really passive at all. It's just a simplified, active algorithm. Get $1 of capital, buy $1 of equity with no reference to fundamentals whatsoever.
Yeah.
Right? It's not
And
just buying the S&P 500. It's the S&P 500 regardless of fundamentals whatsoever.
Yeah, and I think the sort of frightening things about that, right? Like, I think the first is that when investors go passive, right? Right, like you could have one form of passive where you say, hey, I want to own the market portfolio at zero fees. Right, that's sort of like an ideal, like academic version of passive, but that's not what people do. Right,
No.
They don't own the market portfolio at zero fees. Rather, they're 80% concentrated in the S&P 500, if not more. Right, passive is the S&P. And I think that people miss that dynamic, right? Passive in terms of like owning the market portfolio at zero fees, great. Putting all your money in the S&P 500, obviously bad. And if you had to say, why is it bad, or what are the signs, right? Like if 5 years from now we're right, if Mike Green is right, what would you say were the signs of it? And I'd say one of the signs of it that I've written a lot about is there a premium to being a valuation premium to being included in the S&P? Absent controlling for all other factors, right? So control for where the company's listed, control from where its revenues are coming, control for its quality, control for its profitability, control for its growth rate. And the answer is yes, and the premium is massive today, right? Companies that are traded in the US and included in the S&P 500 traded a massive valuation premium to equivalent companies that don't have that benefit. So you go from like P&G to Unilever, Exxon to Shell, right? Even very comparable companies, and you just see this huge valuation drop off. Much less if you go to something like small cap Europe or something, right, where you're looking at paying probably a fifth of the price on a price to book basis of what you do in the S&P.
Wow. And so then,
Yeah.
like, we're back at the when does the bubble pop discussion, right? We're back at we have the disparity. Unilever's making money. How long until I stop underperforming by owning it?
Right. And I think, so far it's this year seems to be, at least so far, the turning point seems to be upon us. Right. I think that the Mag 7 are in a bear market, which is the first time that's been true in a while. And I think there's also just a catalyst for why they've become worse businesses, which there wasn't before, right? Before, it was hard to argue that Google search was a bad business, right? Like you could say how that should be valued, but it's clearly a great business. But this AI stuff, I'm not sure. Like, I'm not sure we've seen the business model. It's just distinctly more risky, and yet they're wagering, 100+% of last year's net income on building out like AI data centers. And you're just like, well, that's an obvious reason. If they're wrong, they're screwed.
Yeah. Yep. That's an obvious reason why the expectations baked into these valuations, since the last, just couple years here, are insane. People are. It's like they're. You know what I think, Dan? It's like they're valuing the 30th year of earnings at a full present $1. It's like it's undiscounted. And then in the bear market, it's just that year gets lopped off to zero, and then lopped off again and lopped off again, to bake in all the losses that eventually materialize, and the outright failures like WorldCom and all the other, the failures of the .com era. Same thing.
Yeah, and I think there's
tons of capital.
a study that I talk about in the book that it's an old study that I updated that looks at the persistence of growth rates. And one of the striking things is that growth rates don't persist. right? Like you take like the top 10%, the top quartile of growers, and look at how they grow over the next 3 or 5 years. And there's no relationship, zero, right? It does not predict anything. And I think this is one of the hardest things conceptually to get your head around, which is that earnings growth is completely unpredictable, completely unpredictable. And the longer, right? And there's another thing, right? Like just like with the weather forecasts, right? Our intuition should be that short-term things are easier to predict than long-term things, right? Like if we can't predict tomorrow, we probably can't predict next month, and we certainly can't predict next year or 10 years from now, right? There's sort of things that we can predict. We tend to be able to predict really well tomorrow, right? And like not that well 5 years from now, right? Like the weather. And I think where you start to see these crazy valuations and they're based on earnings multiple years into the future. And you're just like, come on, like you can't predict any of this stuff. And you should, think about how often you're surprised. And I think, in the book, I quote my friend Woody Brock, who said, the phrase "forecasting mistake" doesn't show up in any economics textbook, but I think people just aren't taking into account how likely forecasting mistakes are, and how likely these crazy multiple-year DCF models that are required to justify owning some of these stocks are so likely to be wrong. And you're
Yeah.
exactly right. Like when it starts to be wrong, you lop off year 30 in your DCF. And if that's having a material impact on the stock price, then gee, you've got a long ways to fall.
Yes. That's where you get to like down 90% on, Tesla or something eventually. Something like that, which is on no one's mind. It's on no one's mind. It's insane how things can be. It's like just like the Nifty 50, or you could say .com. These are the no-brainer things. It's not like it's the risky stuff. It's not like people are saying, well, Tesla's kind of risky, but whatever. No, they're saying these are the no-brainers, right? The Mag 7 are the no-brainers. Of course they'll continue to grow. They're gushing cash. They're the greatest businesses ever, right? Low capex, most of them. So when they go, nobody expects them to go south, right? Nobody expects them to be down, 80% or something in a few years, but that happens. And, Cisco still hasn't eclipsed its .com era high. It's continued to be a cash gushing business, just like generating tons of cash. It did grow revenue a lot slower than before the peak, but it's the expectations baked into valuations. Like you can't, if you don't think that way, you can't convince anyone. You can't talk to them. It's like you say, you can't tell them not to buy the S&P 500. Same thing. We don't get it. Investing is like it's an unnatural act, isn't it? Done well.
Well, I think it's because of this meta-analytic thing, right? Which is that Dennis Hassabis, who founded DeepMind, says that the same neural mechanisms that underlie our forecasts are also the thing are the same neural circuits involved in memory, right? When we make forecasts, we're actually remembering into the future. And that's in some sense the great problem of investing. And the sort of the simple-minded investor is just forecasting whatever happened over the last year is going to happen into the future. And then you get like one order more sophisticated. The guy is saying the last 3 years are what's going to happen into the future, right? And so you've got huge swaths of investors. That's just the way they invest, right? They just rush into the thing that's doing the best. And maybe they do it over the last 3 years, and maybe wisdom is doing what's done over the past 10 years. And when all those things align, when you have just total consensus, that's when you have bubbles, right?
Right.
And I think in order to invest, you've got to be willing to diversify and take the other end of that trade. And the great investors have been the ones that have said, gee, that's that's just totally wrong. I'm going to go totally different direction and been right. You can't go in a totally different direction and been wrong and be a great investor. But the people that have gone in a total different direction and been right, who have resisted the crowd, right? This is like a story as old, like you can go read investment books back in the 1920s, right? You don't just invest with the crowd and win, right? Like the people that good investing is going against the crowd. It's being meta-analytical. It's disagreeing with consensus. It's rejecting optimism. It's saying I have a differing viewpoint. And I think what's been sort of fascinating over the past few years and sort of as a symptom of a bubble is that The right answer has been to go along with the crowd. And the more you go along with the crowd, the better you've done. And I think that creates a lot of risk because beliefs are too correlated.
This is a good place for us to address the final question, which is the same for every guest, no matter what the topic, even if it's a non-financial topic. But the question is simple. If you could just leave our listeners with a single thought, a single takeaway today, what would you like that to be?
Yeah, my single takeaway is that investing is not a game of analysis. It's a game of meta-analysis. It's not what you think. It's what you think relative to what everyone else thinks, right? And so take that barometer, right? Instead of saying, how positive do I feel about this stock or its prospects or this asset class and its prospects, and flip it and say, how positive does everyone else think about this? And then look for the places where you are most likely to disagree. And that is the place where the best investments are found.
Brilliant. Totally agree. Yes. That's one of the reasons why we wanted to have you back on the show, because I knew you would say a lot of things that just had Corey and I nodding our heads, and our listeners too, nodding their heads. So thanks a lot, Dan. I'm really, I wish we could talk for another hour.
I know, this was so much fun. I'm sorry I have to go to this meeting, but thank you for having me on, and let me know when the podcast comes out. I can't wait to share it.
We absolutely will. Thanks again for being here.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.